One of the most common questions that we get from investors who are nearing retirement is, will I have enough income to maintain my lifestyle going forward without running out of money? And it's an important question to ask. After all, you've enjoyed a great life. You go out to dinners with your spouse, loved ones, friends, you go on vacation, you might have some hobbies that you enjoy or giving to church. And the last thing that you want to do is disrupt that lifestyle. And so what you need to do is figure out a retirement income plan. Well, where do you start? It can be overwhelming. And today in this video, I'm going to walk through 8 critical components of retirement income planning so you know the key areas to focus on when it comes to your own personal situation. And hopefully this will help you. If I haven't met you already, my name is Mark Fonville. I'm the CEO of Covenant Wealth Advisors, a personal financial planning and investment management firm here in Richmond, Virginia, and with offices also in Williamsburg, Virginia. We help individuals across the United States plan and invest and enjoy retirement without the stress of money. Generally speaking, most of the folks we help are age 50 and over and tend to have between $1 million to $10 million in savings and investment assets. So thanks for joining. Let's go ahead and dive into today's conversation. Thanks so much. Okay, so what's the first thing that you think of when you think about retirement income planning? Well, it might be cash flow. And I think that's a great place to start when talking through 8 critical components of retirement income planning. So the first thing that you really need to be thinking about is establishing a retirement cash flow plan. And while this may not sound like too much fun, it can be super helpful in terms of helping you visualize where your income's coming from, what you're going to be spending it on, and how much money you need to actually be pulling from your investment portfolio over time. The other thing that it'll tell you is red flags and opportunities and obstacles 2 years, 5 years, 10 years down the road. And it can really help you see the impact to your portfolio. It can help you identify tax issues when you have to make major withdrawals, and really just give you comfort that you've got a game plan going forward. So let's take a look real quick at a sample cash flow plan so you can see what it looks like. And I'm going to be looking over to my left here on my other screen. But basically what you have here is a sample cash flow plan for the George Washington family. And you can see that George and Martha, George is going to be age 66 in 2028, and Martha will be 64 in 2028, and that's the year that they're targeting to retire. And so up at the top here, what we've done is we've included their estimated Social Security, and we've optimized this in this hypothetical plan to give them the biggest bang for their buck in terms of the timing of Social Security. Now, this is specific to them. This would, of course, be very different for you or anybody else who's thinking about Social Security strategies. So you'll notice here that their income from Social Security actually doesn't even start until 2032 when George hits 70 years of age. And then Martha happens to actually start her Social Security at the age of 68. So in these beginning years, they don't have any income coming in, but they certainly have expenses. We put pre-populated some common expenses that we see with our clients. We try to build this out as comprehensive as possible, but for many families, this is, I think, a good place to start. Up here, we've got some healthcare. Clearly, healthcare is going to be a big cost in retirement. You'll see that it's pretty expensive in 2028 because Martha is yet to go on Medicare. So she's got to purchase healthcare from a private insurer or through the Affordable Care Act. We've also got car purchases periodically throughout. We've got some travel, we've got charitable giving. They like to give to their church. And at the end of the day, you've got total goal funding. That's the amount that George and Martha are going to spend in any given year. The first year of retirement is going to be $183,000. And that's because they have a car purchase that they need to make. That's going to normalize in 2029 down to about $127,000. but they've got to be taking this from somewhere because they don't have any extra income. They don't have any extra pensions or Social Security in this situation. You might in your situation, but they're going to need to take $183,000 from their portfolio down here just to cover the cost of their lifestyle. And that's okay. That's what they save for. But hopefully this gives you a really good idea of what cash flow planning looks like in retirement and really what it looks like and why it can be helpful. We'll create another video to go a little bit deeper into this so you can understand it a little bit better. So that's number one, establish retirement cash flow projections. Number two is run a Monte Carlo analysis. So what is Monte Carlo? It's just a fancy word in finance that we use that really just means a stress test. So a stress test is taking all of your income that we just saw in the cash flow report, is taking your expenses, and it's taking some assumed rate of returns that you may achieve on your portfolio. And then it's running one simulation to find out if you're going to be successful in retirement. In other words, are you going to be able to afford your lifestyle without running out of money? So it runs one simulation. Let's go ahead and we're going to take a look real quick at what that might look like. And so I've got my whiteboard here. Let's take a look at Monte Carlo. So let's say today the Washington family has $2 million. And one simulation we might run, and it might run something like this. So this is their balance over time. And that would be one simulation. And this is just hypothetical, but that simulation might reflect in year one a negative 10% return, and then a positive 3% return, and then maybe a positive 5% return, and so on. Clearly, when you're investing, the returns that you get from year to year are going to be different. Not every year is going to be great. And so that one simulation can be helpful to see, hey, if we randomize returns on the portfolio, what does it look like? Let's run another one. So let's say we run another one for the Washington family, and they end up running out of money before they run out of life. That's a problem. That's important to know. So what Monte Carlo is going to do is we're going to run 1,000 of these simulations to get an estimate of how many of these 1,000 simulations is successful. And then what you'll find is we'll go ahead and come up with a probability of success. And so maybe in this situation, the Washington family starts with a 65% success rate. Well, what can we do to improve that? That's our foundation. That's what we start with. Then you can take retirement income planning strategies to potentially boost that to maybe a 90% success rate. And so really that's what Monte Carlo is about. It's just about running simulations with your personal situation to figure out the probability of you enjoying life without having to drastically change your plan long-term. So that's number two, run a Monte Carlo analysis. Number three is identify the best Social Security strategy. So many people get this wrong and they think they should choose or time Social Security in terms of taking it as soon as they can. While that may be good for some, it's not great for others. We just saw for the Washington family, we were starting Social Security at age 70, which is the latest that you can apply for Social Security, but everybody's different. And so if we take a look, for example, I'm going to move this over, I'm going to pull up a screen for Social Security analysis. So for the Washington family, what we've done is we've gone ahead and we've run really hundreds of Social Security timing scenarios and come up with the top 5 here. And in their situation, we have several scenarios. They could take it as soon as possible, each at age 62. We could take it at their full retirement age, which for George is at age 66, or basically at his retirement, Full retirement would be full Social Security retirement age, which would be 67 for both of them. Or they could take it at age 70, or they could do a blend, age 70 for George and age 67 for Martha. You can do everything in between. There are literally hundreds of combinations. So what you'll notice here is the total lifetime benefit based on the idea that they live to their life expectancy. And you see, these are huge numbers, right? It goes all the way from $1,265,000 up to $1,829,000. That's a huge benefit, right? And so you want to make sure that you get this right for you and your family. It just so happens in this situation that taking it at age 70 for George and at age 67 for Martha tends to make sense. But you'll notice here the probability of success, that's pulling in the stress test from Monte Carlo. So now we can see, wow, if they take it as early as possible, they only have a 66% chance of maintaining their lifestyle without running out of money. But if they go ahead and extend Social Security out, thereby getting a larger benefit, their probability of success increases to 80%. So you can see why Social Security planning is so important when it comes to retirement income planning. And that's point number 3, identify the best Social Security strategy. Point number 4 is analyze Roth conversions. So a Roth IRA is a retirement account where you put money in on an after-tax basis. The money grows tax-free. And then when you pull the money out, typically after age 59 and a half, you pull that money out tax-free. So it's a great source of potentially tax-free income in retirement. The problem is that most people don't have access or they haven't built out their tax-free account. So what do I mean by that? Well, there are 3 types of buckets when it comes to diversifying the taxation of your income in retirement. The first bucket looks something like this, and it might be tax deferred. So that's going to include your IRA, regular IRA, not a Roth. That could include your 401k and other retirement plans. The second bucket is going to be your taxable bucket. The taxable bucket is going to include things like a brokerage account. We'll put a B for brokerage, or a trust account. The difference between taxable and tax deferred, when you pull money out of a tax deferred account, every dollar you pull out is going to be fully taxable. Okay, well, that's not great when you retire, but up front, usually that money goes in before tax. So it benefits you during your working years, but once you retire, it really hurts you because your tax bill could be a lot higher. The taxable account, however, only the gains, typically if you do it right, are taxed at long-term capital gains rates. If you don't do it right, those gains could be taxed at short-term capital gains rates, which can be a much higher tax. So there are ways to manage your taxable account to be much more tax efficient. The third bucket, and to our point, is what we call the tax-free bucket. So the tax-free bucket is going to be things like your Roth IRA. It's going to be something called a HSA or a health savings account. This is where, again, you put money in after tax, it grows tax-free, and then when you pull it out in retirement, you pull it out tax-free. So here's the problem. Most people who retire, at least the clients that we work with, they fully funded their retirement accounts. That's looking great. But now they have a problem. They don't have control over their taxes in retirement. So Roth conversions and a Roth conversion analysis, what that can do is help figure out how much does it make sense to move money from that tax deferred bucket to the tax-free bucket. So that can be really important because it can give you better control over taxes in retirement. It can potentially save you tens of thousands. We've seen situations where it can save hundreds of thousands of dollars over time. So you want to make sure to include that in your retirement income plan. So point number 4, analyze for Roth conversions. Point number 5 is look for backdoor Roth IRA opportunities. If you haven't retired yet, you're still currently employed, maybe you make too much money and you can't contribute to a Roth IRA. That's where the power of a backdoor Roth IRA comes into play. And without going into too much detail, there's a way to actually get money into a Roth IRA if you make more than the IRS income limitations. And so you want to make sure that you've analyzed for this strategy as another way to stash money away in that tax-free bucket. So that's point number 5, backdoor Roth IRA. Make sure you analyze that. Number 6 is analyze for a mega backdoor Roth IRA. The mega backdoor Roth IRA really builds upon the backdoor Roth IRA idea and allows you to max fund that Roth IRA well beyond what you could do for standard contribution limits. And the best way to get started on figuring out if you qualify is take a look at your 401k plan, your 403b plan, or TSP, just your retirement plan through your employer, and ask them if they have an after-tax contribution feature. If they do, that's a great start. That's what you need to know in order to do the mega backdoor Roth IRA. And the details from there get a little bit more complex, but it's definitely worth figuring out. So you want to make sure you include that in your retirement income plan. Okay, point number 7 is optimize your order of withdrawals from your retirement accounts. So traditional thinking is withdraw from that that taxable bucket first. You remember the bucket that I drew earlier. Second, withdraw from your tax deferred accounts like your IRA and your 401k. And then third, go ahead and pull from your Roth IRA. Here's the deal. In practice, what we've seen at Covenant Wealth Advisors is that's rarely the right way to go. When you start incorporating tax planning and you really see the impact of making withdrawals from different accounts, what you find is that a combination of withdrawals tends to be most optimal for people. Not in all situations, but you really want to optimize that so you withdraw from the right accounts at the right time, and that can potentially save you tens of thousands of dollars long term and help make your money last. So that's point number 7. Make sure you optimize for the order of withdrawals once you retire. That should definitely be included in your retirement income plan. And then finally, point number 8 is analyze your pension decisions. You may not have a pension, and that's okay. A lot of us don't anymore. But for some of us, you may have a pension option to either take a lump sum, you might be able to take it for life. And then you've got to make a decision, well, what should the survivor benefit be for my spouse? Should she get 100% of my pension after I die? Should she or he get 50% of my pension after I die? What's the right feature to choose? Well, you need to figure that out, because let's say you start your pension, you did a 0% survivor benefit, you get hit by a beer truck, and the next thing you know is your spouse won't receive any of that pension, and that could put him or her in a really difficult situation. So you want to make sure that you incorporate pension decisions within your retirement income planning. And so with that, I'll walk through again. Number 1 was establish retirement cash flow projections. Number 2, run a Monte Carlo analysis. Number 3, identify the best Social Security timing strategy for you. Number 4, analyze for Roth conversion strategies. 5, backdoor Roth IRAs. 6, mega backdoor Roth IRAs. 7, make sure you optimize the order of withdrawals from your retirement accounts. And then 8, make sure you analyze the right pension decisions. If you do this and incorporate all of these into your retirement income planning, you will put yourself in a much better position to make your money last. There are no guarantees when it comes to investing or planning around money. But what we tend to see is that focusing on what you can control can really optimize your outcome. And so with that, I hope you've enjoyed this video. If you like what you've heard, please go ahead and follow us if you're watching this on YouTube. And we'll put a few notes in the discussion down below for different checklists you can download to help on your journey. So with that, thanks so much. We'll see you next time. Bye-bye.